This is our Forex blog for April 5th, 2012. I'm going to scroll the charts back so that we can start at midnight. And like we do most days, we want to trade in the direction of the most likely trend direction. We statistically compare every currency to every other one. This is one of our easiest methods of trading using our software. And the histogram on the top shows a real-time strength or weakness. This is composed of 5 of our best statistical trend tools. 3 of those measure direction, 2 of them measure intensity of direction, and underneath that we have the daily, weekly, and monthly trend. So primarily I'm looking at the histogram because I'm an intraday short-term trader myself. I'll hold trades for as small as 5 pip win to 50 plus pip. But if you're a longer-term trader, you want to look at the weekly and monthly trend. You can somewhat ignore the monthly because it takes way too long to change direction, but the weekly is important. So you can see the weekly trend is up today. So once you see some momentum come into the upside, followed by less momentum during the counter trend phase, that longer term weekly and monthly trend is likely to reassert itself. So coming up to 4 right here, the dollar is very likely to go up, and it does. Same thing here with the yen. So you want to trade that against one of the weaker ones. The euro is extremely weak. The Swiss is extremely weak. And so you have those 4 currencies to trade. You want to sell the euro dollar, euro yen. You want to buy the dollar Swiss, and you want to sell the Swiss yen. Because you got to know which ones are on top. The yens are always on the bottom. So if it's strong and another currency is weak, you're always selling the weak one. If we were selling the euro yen, if we were trading the euro yen, it would be a sell too, because the euro is always on top with all the other pairs. The yen's always on the bottom. You know that after about a few days of trading. All right, so let's look at the euro dollar coming up to 4. You're looking to sell this. And this is a range chart showing the euro dollar. Let's click on the bar chart to see what time it is. So here's 4 o'clock right here. It's kind of hovering around, not doing anything. This is a range chart, so if the market's not moving that much, you have very few bars. Once the market does start to move, you have a lot of bars. And notice, how using our intelligent trailing stop, which this trailing stop is made of all of our best statistical tools. If there is real-time weakness, it will have a wider stop. If the weakness turns to strength, we tighten the stop. If the market moves statistically too far, such as underneath the lower bands, we also tighten the stop. So there's a lot of sophistication in about 6 or 7 rules that decide whether to have a wide stop or a tight stop. Because of that, it makes a really good entry and exit signal. So if you had entered right here at 42, you're out at 22, you made 20 pips. Short again right here at 12, got you all the way out here at 69. So you made 42 pips on the second trade. Now myself, I use on range charts a 3 to 5 bar reversal pattern. Once you find a strong trend like this, and you can see it hit the minus 80 level right here, that's significant weakness. After 3 to 5 bars counter trend using a range chart, I've never used this on anything other than a range chart. The first bar that goes red, you basically simply want to sell it when it goes 1 pip underneath there. So I would have actually sold right there with my stop just above the high here. And that way, if it triggers my entry and doesn't actually change the trailing stop from short to long and vice versa, you're risking 6 pips plus 1 pip padding plus your spread. You always have less than 10 pip loss, and you can sometimes get into these trades a little bit early. Instead of 11, it might have been here at 15. So that's 4 extra pips profit in this example. And if the trade didn't work, it's 4 extra pips or 4 less pips loss. The real key to trading is small losses, big wins. It's not rocket science. The lower 3.0 band is usually where the market reverses. So once it gets underneath there and it goes up 1 bar, I'll move my stop right above this bar, because typically you're going to get a reversal down here. And you can see it's better to get out at 65 versus 69. That's 4 extra pips. So if you use my entry method and the containment bands to exit, you made an extra 8 pips on this. Now keep in mind, a lot of traders, especially new traders that know absolutely nothing, seem not to care about 10 pips. But 10 pips per day, you have a $2,000 account, it pretty much doubles every 8 weeks, 2 months. You can see that, see? 8,000. Another 2 months goes by, 18,000. At the end of the year, because of compounding, it's 258,000. Obviously, you're trading huge 51 lots at a time then, but with a smaller account, you're only doing 4 mini lots to begin with, which if you have a 10 pip stop, is risking basically 2% risk per trade, which is very low risk. That's what we advise. All right, so let's look at some of the other examples. This is a euro dollar. Here's the euro yen. We're going to go back and look at this at 4 o'clock as well. Here's 4 o'clock. This one's kind of going sideways. Notice also the price is underneath the hourly right here. But if you just simply used our trailing stop method to get in and out, you're short at 05, out at 78. You just made over 25 pips. If your goal is 10 pips per day, that's a half of a week's profit in one trade. Short again right here, 81, out at 64, and again here at 54. And remember, when it gets underneath the 3.0 bands, which I like to color green, it almost always will reverse 10 to 15 pips. So I probably would have been out of this trade right here at 16. You can see if you had used the trailing stop instead, it got you out here at 14. So you only made 2 extra pips in that case. The other example I gave, we made an extra 4 pips. I always like to get out as soon as possible and kind of wait and see what happens. Down here near the 3.0 band, it's usually risky to sell. I'm going to kind of wait for the weakness to disappear and look for counter trend trades myself. Right here you can see the weakness has kind of subsided. So after it pulled back again and started to go back up, this is where I start looking to do counter trend trades. And most of the time it's going to retrace back up 38%. That's an excellent profit target when you do counter trend. That's right here at 46. So if you had bought later today at 03, you have about a 43 pip potential profit, and it actually overshot the 38% a little bit. But if you're risking 6 pips plus 1 pip padding plus the spread, and you have a good chance of making 40 pips, that's 4 times bigger potential win than what your loss is. And you certainly can use the trailing stops to trade that all the way up to that level. You certainly could, remember this is after 3 to 5 bars down, typically you get a reversal, especially at these extremes. So 1 pip above the green bar here, in at 03, out at 17, in at 24. You haven't even got out yet, or at least at this point of the day. You can see it went further, out at 56. This last trade you were in at 24. So you have, once the market's gone statistically too far, you start looking for signs of reversals. This counter trend, big yellow dot right here, is a big sign of a likely reversal. And when that happens, you can look to do some counter trend trades. A few pips here, a few pips here, a few pips here, and about 25 pips on the last one. So another one that was weak was the Swiss. So especially at 4 o'clock when you got this nice clear reversal pattern, the weekly and monthly trend is up, and you can see the daily trend had shifted from very weak to just barely weak. And anytime you see that, it's only a matter of time usually before the weekly and monthly trend will reassert itself, and you can see it less than an hour later, all the time frames are up. Let's take a look at the dollar Swiss coming up to 4. This one's kind of hovering around here. It went from underneath above the hourly if you wanted to buy right here, because sometimes when they shoot from underneath above the hourly, they explode up. Here's my fib level, which I predicted last night is the likely high, and it was. So you have a good potential. Even if it goes to this first resistance area right here, it's 20 pips away. You're risking 10 pips to make 20. That's a good bet. In at 59, out at 63, small profit. Pulls back a little bit. You can see as it's going sideways right here, the weakness disappears. The daily trend, weekly and monthly, it all shifted up right here on this bar right here. And as soon as it breaks back up and the bars go green, you can see it went from 57 all the way up to 07. That's a 50 pip win. And if you use our trailing stops on the 5-minute chart, which some people like, it kept you in there until about 92.01. And here at 60, there's 40 pips. And usually when the market hits the 2.0 white band, you're going to get about 15 to 25 pip minimum pullback. This one just kind of pulled back and went sideways. You always want to give it about an hour to pull back. Usually they're going to pull back 38% at the minimum before they retrace back up. This one was so strong it didn't. So, give it a half an hour to hour and a half. When it starts to go back up, you can take those trades. Maybe you might have been in here at 94 or even at 98, out at 12. So, 10 or 12 pips. And the upper containment band, especially when it's at or beyond the 3.0 containment band, this Fibonacci profit target level I do each night, so you don't have to. I spend 30 to 40 minutes for my own trading each night, update it in our website, and it automatically plots it on your chart so you don't have to. This is a Fibonacci profit target level that I thought would be the high today, and it appears that it was, at least at this point of the day. It hasn't broken it since. I don't leave the the Swiss yen running. I will bring that up right now. Remember, weak Swiss, strong yen. This one's underneath the hourly. And you can just simply take trades when the trailing stops get hit, or if you want to bring up a range chart, which I will do right now. We'll put 2 days of data on here because it has to go get tick data. And we'll just put a 6 pips per bar chart up. It's going to go get tick data, and then this will populate. And I personally prefer range charts. They're, to me, a lot cleaner most of the time than minute-based charts. And this is a good example of the 3 to 5 bar reversal pattern. Once you find a trend, in fact, this is also the same thing. 3 bars up, 1 red bar, you go short, it falls. 3 bars up, 1 red bar here. And I really like seeing a reversal pattern that actually has a wick like this. Wicks on range charts tend to be reversal signals. Notice right here, right here, right here, right here, right here, and right here for quick little 10 pip counter trend moves. You know, all these wicks right here, reverse down, wicks on the bottom, reverse up. So anytime you have a 3 to 5 bar up followed by a bar like this that has a wick pattern on it, it's even higher odds. You draw your fibs on that previous move, and you have your profit target. Usually it reverses somewhere between the first and second fib target. You never know how much it's going to reverse, but this is an excellent place to take your profit. You're risking 6 pips plus the pip padding, 10 pips or less. If you're short here at 59, your profit target is at 28. So it's basically a 30 pip potential profit, in this case it was, while risking 10 pips. That's 3 times bigger win than loss. And again, that's the only secret to trading that you really need to know about. Here's a nice reversal again. Put your stop right above the high. You can trade off of range charts without even any indicators. If you see a big move down, you just simply draw your fibs and you have your profit target. You're short right here. Here's your profit target. And it, kind of only reversed 10 pips and then came down and found support near the 1.618. And later on as well. That's how you use the range charts. Obviously if you leave these running and you have all our other tools on there, it adds to your probability. The 3.0 containment band is usually where the market's going to reverse at. They usually don't go more than 5 to 10 pips underneath there. Let's add that to this chart right here. We'll put the containment bands on here. 3.0. I always like to make them green just so everyone knows from the videos what it is. And guess what? This is exactly where the market reversed. And in fact, it reversed from around the 89 level all the way up to 89.55. 55 pip reversal. So don't get greedy. When it gets down to that 3.0 band, look for a reversal. You can see the exact same thing here. Little pop, little pop, little pop. And then again, when it started going up here from 75 all the way to 25, 50 pip reversal.